don't know if you have the answer to this, but historically, Jaron and ours move has been accelerate the depreciation on assets that we buy before the end of the year. So own an asset. So this is similar on some level, or how does that?
So accelerated depreciation and bonus depreciation are synonyms, right? So okay. Everybody that's in real estate is kind of doing that themselves with their own portfolios, as you just mentioned, as you should, right? As you're doing cost segregation exercises as well.
Exactly.
And a lot of times what ends up happening is as your portfolio grows, as your net worth grows, you've swung the bat as hard as you can with your own portfolio, and you're still having additional passive income that you can't shelter, right? So this is where the bonus depreciation or accelerated depreciation funds could be an option to evaluate, to rule in or rule out, versus what we always tell our clients, hey, if you want to guarantee, don't do any tax planning and just pay the tax. That's guarantee loss, right? That money's gone. We're not getting a dividend on it. We're not reinvesting it. So before we make that decision, let's invest 30 minutes to have a call with your CPA and look under the hood at these fund offerings to see if they would fit your facts and circumstances.
That's awesome. That's awesome.
Yeah,
That
makes sense. Let me ask you a couple questions about the DST assets. I'm assuming these are not assets that you're managing. I'm assuming these are assets that are other syndications are putting together. Syndicates are bringing to you. You're vetting them. You're seeing what their track record is. Tell me if I'm barking up the right tree here. And
Jaron, you're exactly right. So first off, we acting as fiduciaries, right? We're very transparent, agnostic. We're completely independent in the due diligence and compliance process. So unlike certain folks that might be in a similar sector of us, we do not take ownership of any of the properties. We have no influence with any of the syndicators or sponsor companies' leadership or management team, right? On purpose, because we're sitting on the same side of the fence as our clients are as we go through the process of really understanding each one of these offerings, right? There's, 40, 50, 60 different sponsor companies out there. There are certain ones that obviously have been around a long time, that have very, very good track records, right? Very strong leadership and management teams. And then there's other sponsor companies that are really trying to emerge and, gain traction in the space, but they just don't have the experience. They don't have the track records to reference yet, but they might have a deal that's worth considering, or they might not, right? So our job is to kind of do that. We have our, proprietary process that we do internally with our broker dealer. So, if we approve a deal on our platform, it's something that we feel very comfortable with. And we always tell our investors, 1031 DSTs are not investments that are going to double your money. The returns that a real estate investor are going to get by managing their own property could certainly have a higher risk reward profile. Most of the investors that we deal with, they want to know that they're going to get moderate to modest dividends and moderate to modest property appreciation, and they don't have to deal with any of the other headaches, right? They're a passive investor. A lot of our clients call it mailbox money, right? And they're not interested. They've swung the bat to do all the things over the years with the tenants, the taxes, the toilets, and the texts.
Got it. And
I've had friends who have chosen to go the route of investing in syndicated deals over the years. They're not in the real estate business, but they're savvy enough to evaluate some of the different syndicators out there and make some decisions and invest some of their money there. And they've soon they will be receiving a lot of gain on this when these guys eventually sell, and it looks like that's coming up here. Some of them have sold already, but so for somebody who is invested in syndicated deals, this also could be a pretty good option, right? They can 1030 out of the syndicated deal into a DST. Is that fair to say, or?
Yeah, so it'd have to be specific to the deal, but assuming the investment you're referring to is 1031 eligible, right? When they sell it, if it's a 1031 eligible investment, then yes, all the DSTs would be in play. And I will say this, because this does come up. We do have a lot of ultra fluent clients that obviously are passionate about real estate, right? And there's many clients that actually will put cash in their portfolio into certain DSTs. Now, not all DSTs will accept cash investments. Most are just 1031 eligible investments, but there are certain deals, certain sponsor companies that'll take cash investments. And I'll give you an example. We had several high net worth clients that were alumni from the University of Notre Dame. Notre Dame's student housing portfolio came out several months ago with an offering on the DST side. So we had on-campus living student housing at Notre Dame. I think it was like a $40 or $50 million raise. And we had a number of investors that were not necessarily 1031 investors, but they were looking at their traditional security portfolio. Equity markets have been running hot for a little bit. There's some political uncertainty. They said, you know what, it'd be nice to have a little sleeve into something a little bit different. And they would do maybe $50,000, $100,000 increments just to get the exposure. And also, I think for a lot of them, because they're alumni, right, it was something nice to talk about on the golf course or at a cocktail party. So we do have offerings like that I think would for certain investors be good to know exists.
Could you tell us, I know every investment is different. I know every offering memorandum is going to have different numbers, but what are you seeing out there for returns, either dividend estimated dividend returns per year or IRR percentages? What are you seeing out there in some of the deals that people are getting into and that you're offering?
Yeah, great question, Jaron. So right now on the dividend side, I would say that the spread on the dividend distribution amongst all the sponsor companies is anywhere between 3.5% to 7% in dividend distribution. Now, keep in mind with the DST, those dividends are paid monthly. So if we have a client that puts $1 million of equity into a series of DSTs that's paying, let's say, 6% dividend distribution, right? That's $60,000 a year or $5,000 a month. That's ACH to their checking account every month. You don't have the option to reinvest the dividend. You have to take the dividend out.
Okay.
On the property appreciation side, it really depends on the sector. Most of the DSTs, like I said earlier, are moderate investments. So they're looking at anywhere from 3 to 6, 5 to 7% property appreciation per year. So on the total IRR side, you might be anywhere between 8 to 15% annually between the number of different dividend or the DST sponsor companies, right? That also is a function of the sector of real estate and the approximate hold time that the sponsor company is targeting before they sell the property, and then the investors are back at the table to do another 1031 exchange, either back into DSTs, back into active properties that they manage, any combination of the two, or as we refer to it, swap until you drop.
So you could come back out of the DST and get back into your own property. So the example that I could see happening a decent amount for some of my clients who they're scrambling at the last minute. They're at that 35-day mark, 40-day mark, and they're trying to identify those properties. And maybe they've identified one, but they have an inspection period and they don't know if they're really going to like the property. They could work with you. They could put a DST on their 1031 exchange list. Then let's say that property doesn't work out. They then put the money in the DST. Let's say the fund is a 4-year fund. Hypothetically, at the end of the 4 years, they could then 1031 that money back out into one of their deals and go back to being an active investor, or any other option, putting it into another DST, et cetera. But they have all those options available to them. Is that correct?
Yeah, precisely. Exactly. And a lot of times what we see for those scenarios is really two things. One is a client ran out of time, right? The 45 days was coming up. We get calls across the country. Hey, Bryan, I'm in day 42. I hear you're really good at this. Help. What do you have? We're stuck, right? So that's one option that we see a lot. And because they were stuck, the intention on the design is to try to identify a DST that maybe is on the shorter side of hold time, so they can go back into the game, so to speak, themselves and handle their equity however they want. The other option that we see a lot outside of that is we have clients that are in a position right now where they can really get a premium for their property, right? Because there's not a lot of supply. Maybe they never really wanted to sell because they always thought they were going to get hammered in taxes. Now they know there's another option and they can get a premium. So they're going ahead to finalize the sale. They're preserving their step up in basis. They're deferring all their tax. They're getting, in many cases, the same or more tax advantaged income. And then they're just going to play it by ear down the road. Hey, if there's something that they really like, that they want to go manage, great. Otherwise, they're comfortable wearing the passive investor hat and kind of riding the wave where it takes them.
That makes sense.
What's the shortest DST time frame or hold time frame you've seen?
Yeah, so right now there is one particular sponsor company that's targeting a 3-year hold time, but they also have some provisions in there for 12-month extensions if needed. But I'd say, generally speaking, 3 to 4 years is on the shorter side. I'd say more average industry is in that 5 to 6, maybe 6 to 7 year time period. With that being said, we've seen scenarios play out on both sides of the spectrum. We've had very, very good sponsor companies target a 5-year hold or a 5-year, full cycle. And we'll get a phone call at the end of year 3 saying that they got a, phenomenal offer on the property. We actually had one in the state of Florida not too long ago with a multifamily development that was targeted a 5-year hold. They ended up getting a number that they really liked in year 3, and the investors got well over 20% IRR. So you see that happen occasionally. Obviously, the markets were different several years ago than they are now, right? But you also see the other side of it. Let's say they target a 5-year hold, and now we're in year 6, and we have some investors going, "Hey, Brian, what's the latest here? Give us, kind of give us an update. What's the sponsor company seeing?" And the sponsor companies are managing the properties also as a fiduciary. What's in the best interest of all the investors? And if there's certain headwinds or tailwinds in the real estate market, that's just not a good time for them to sell, and they're just not getting a number that they think, lines up with their pro forma, then they don't have to sell. They'll continue to manage the property. It's cash flowing, and they're just going to wait until everything kind of lines up. So you have both sides of the spectrum.